Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Jason Bloom, Head of Fixed Income and Alternatives ETF Product Strategy at Invesco. We are talking about commodities today, and commodities had their best quarter in more than 30 years recently. They were already benefiting from inflation, and Russia-Ukraine war really supercharged the rally. Jason, welcome back. Great to have you on the show.
Thank you, Neena. Nice to be back.
So prices of commodities, including oil, gas, wheat, metals, they have all surged this year, and we have also seen some very, very wild moves. And let's start with oil and gas. We know that Russia is the world's second largest producer of natural gas and third largest oil producer. So, of course, oil and natural gas prices have surged due to the war and sanctions imposed on Russia. Now, last week, President Biden announced that the U.S. would be releasing about 1 million barrels of oil per day from strategic reserves for about 6 months. So oil prices came down a little bit, and then they are up this week again because there are reports of additional sanctions on Russia. And then there are reports of possibility of easing sanctions on Iran and Venezuela, so some additional barrels from those two countries, and those two are big oil producers. We also hear about economic slowdown in China, which is thanks mainly to their zero COVID tolerance policy, so that may impact the demand for oil. So what do you think about the outlook for energy, oil and gas in particular? I have read some reports that we are probably in the early innings of oil bull run, and there are some strategists who are projecting that oil could hit $200 or even $250 a barrel in the coming months. What do you think of oil? Where is it going?
Sure. Well, you have to temper any forecast with, the humility of not being able to predict for sure where the course of the war is going to turn. That being said, we do have certainly a base case and a view that, based on the behavior of the combatants in Ukraine, both Russia's behavior and Ukraine's fierce resistance, that this conflict is looking like it will drag out. And when you look at most of the commodities that are being directly impacted by the war in Ukraine, it is really the duration of the conflict that is the key factor. And again, our view is based on the behavior of the two parties that this conflict is going to drag out for some time, which creates additional upside risk for those commodities that are being impacted. Certainly, crude oil. Give or take, roughly 3 million barrels a day of crude exports from Russia are offline due to sanctions or self-sanctioning, actually, right? That we're not directly sanctioning crude oil exports, but a lot of buyers are avoiding Russian crude cargoes for a variety of reasons. Difficult to pay for them, difficult to get a ship to dock at a Russian port, difficult maybe to find insurance for the cargo. And we do believe that over the course of the year, buyers will eventually find their way through sort of a new network of plumbing to get access to Russian crude, since it's not being sanctioned. But of course, there is the risk that it will be directly sanctioned, depending on how Vladimir Putin moves forward and the behavior of Vladimir Putin and the Russian army. So that leaves at least 1 million barrels a day off the market for likely a year or more. So to the extent that the Biden administration is releasing 1 million barrels a day for 6 months, they haven't, they barely solved half the problem for the year, and actually far less than half. the problem. So one of the reasons you haven't seen a big move down. The other is that they've spent all of their ammunition as well, right? This latest announcement regarding release of crude from the strategic reserve, essentially they've spent all their bullets. And if we're at 100 after that announcement in $100 a barrel in WTI, the significant risk for upside move based on a further escalation in the war, further escalation in sanctions, the likelihood of additional barrels coming from Iran or Venezuela, very, very low. The Biden administration has backed away from dealing with Venezuela, another quote bad guy out there. Going from one bad guy to the next for crude oil is not something that it sounds like a lot of commentators want to see the U.S. do, and it would take a long time and a lot of investment for Venezuela to get their aging and decrepit oil infrastructure up and running again. Same problem in Iran, to the extent that Russia was previously a major part of those negotiations and a party to the potential removal of sanctions and the agreement that was being put together. That is actually due to Russia's involvement with those negotiations. The likelihood of Iran coming back in the near term is quite low as well. So as the world continues to reopen, so to speak, demand is continuing to increase as travel picks up and the COVID restrictions subside, and significant impairment, right, of crude flowing from Russia looks likely to persist. So, yeah, it's not a coincidence that we've seen $200 strike price call options in crude oil trading in meaningful volume. A year ago, the $100 strike price was trading, and people were kind of laughing, thinking that was, an extreme outlier. And of course, we got there, and those options have been in the money for the last few months. So the fact that it's trading, that those options are trading at that $200 strike indicates that the market believes there's a significant risk, at least, not necessarily forecast, but a high risk that we could get to those levels. We probably wouldn't stay at those levels because most economists estimate that crude prices would eventually destroy their own demand, essentially around between $150 and $175 a barrel. Eventually, people would would burn less gasoline, burn less fuel, look for alternative sources, and start to pull back. But we'd have to stay there for a period of time for that to happen, and we'll see. We'll see. We hope we don't get there. There's so many consequences that would flow from crude, moving up to significantly higher levels. One of not the least of which would be having an creating additional upward pressure on inflation in the United States. There's no commodity more highly correlated to inflation than crude oil and the energy complex. Industrial metals are a close second, and then of course that'll take us through, I think, to one of your questions later on here, likely in the conversation, is the impact of wars having on metals. But there's an interesting sort of vicious cycle occurring right now with respect to commodity prices, inflation, and the war in Ukraine. And we'll have to see how that plays out. So yes, I would, if someone forced me to take a new position in the commodities markets, I'd much prefer to be long than short. You mentioned the slowdown in China. So, what are the risks to the downside? Because I've spoken a lot here about risks to the upside. Certainly, additional lockdowns and a reduction in economic activity and transportation demand in China as a result of the continuing impact of COVID there. It speaks to the strength and the tightness of the crude oil market that we had the announcement regarding the SPR release and lockdowns in Shanghai, and we've still got crude oil holding around $100 a barrel. It speaks to how incredibly tight the market is. And you look at that, not just crude oil, not just energy, but across metals and agriculture, inventories are generally low across the board. And there's just no cushion in the system for a supply shock. And we've been getting supply shocks.
Right, I agree with you. There are more upside risks than downside risks, and particularly if the war turns out to be a long, drawn one, and which appears likely at the moment. So Invesco offers two oil commodity ETFs, DBO, which is in Invesco DB Oil Fund, and DBE, which is Invesco DB Energy Fund. Both these ETFs invest in energy futures. Talk to us about these two ETFs. What futures do these ETFs hold, and the difference between the two ETFs?
So DBO is going to give you targeted exposure to crude oil. DBO only holds the WTI futures contract, West Texas Intermediate Crude Oil Futures, which trades here in the United States. So that's the single holding in that fund. DBE, on the other hand, gives you a little bit more diversified exposure to a basket of energy commodities. So you're going to own WTI crude oil. You'll also own Brent crude oil, gasoline, diesel, and then a 10% allocation to natural gas, all through those futures markets. And then what I think separates these two funds from many of the competitors is that both funds optimize the futures roll, meaning that we don't just hold the front month contract and then blindly roll to the next month on the calendar every 30 days or so. Each fund, when it's time to sell the expiring futures contract and roll to a later dated contract, each fund looks at the shape of each individual commodity curve and rolls to the contract offering the best available roll yield on an annualized basis, an annualized calculation, that is, and then holds that contract until approximately a month before expiration, and then makes a calculation and rolls again. So you may be near the front of the curve, you may be in the middle of the curve, you may be 12 months out the curve. They don't go more than 13 months out the curve in any event. And that optimization process has been the way that these funds operate since day one, since being launched well over a decade ago. And it's one of the reasons that we've become a leader in the futures-based commodity ETF space.
That's very interesting because we know that contango is one of the biggest concerns for investors who use these ETPs that invest in futures. So minimizing contango is important. So that's an interesting feature of these ETFs. That's very interesting. So let's talk about agricultural commodities now. And these two countries, Russia and Ukraine, they are major exporters of grains. And Russia is also the world's top fertilizer exporter. And we know that Russian grain shipments are also impacted by sanctions and supply chain disruptions. And also because the conflict, as we discussed earlier, it is not showing any signs of easing as of now. So Ukrainian farmers are finding it difficult to plant and tend to their crops. And I recently read a report that Ukraine anticipates that its spring crops will be cut by half because the planting window is like just a few weeks, and if they are not able to plant within that window, then that crop is gone. And then there's the impact of rising energy prices too, right? Because higher energy prices impact production and transportation of fertilizer. They also impact transportation costs of grains. So talk to us, there's a lot going on. So can you unpack all this for us and tell us what it means for agriculture commodities?
Sure. So as you mentioned, wheat gets most of the attention because, Ukraine and Russia are the two largest exporters of wheat in the world. A significant portion of the global supply comes from those two countries. And to your point exactly, we are now in the process of significantly impairing the current planting and, of course, the harvest then that would occur at the end of the summer here in the Northern Hemisphere. Those cargoes are not easily replaced. To some extent, they're not replaceable. So the risk is that we're facing food shortages in certain parts of the world that depend on the wheat that comes from that region. It's not only therefore very bullish for wheat prices, which are up 35% year to date, up almost 4% today alone, it's also going to likely pull higher the prices of other crops that could either be used to substitute, so corn. Now, corn prices are going up also because, as you mentioned, the price of fertilizer has skyrocketed, and corn takes a lot of fertilizer. So the cost of producing corn for farmers is going up dramatically, as well as is the cost of fuel to run the tractors. So also what's not discussed as often is that Ukraine is responsible for a huge portion of the sunflower seed exports, and sunflower seed oil will be in short supply. So that is likely to pull up the price of soybean oil and palm oil as replacements for the sunflower seed oil. So soybeans then therefore are rallying as well based on the conflict in Ukraine extending through this planting season. So yeah, very bullish for really a major part of the agricultural commodity sector, in addition to having I think somewhat frightening implications for food supply in certain parts of the world, and then of course it'll be interesting to see how this plays out. But when people start to run low on food and are going hungry, that tends to lead to political instability. And you think back to the Arab Spring and some of the events around that, food shortages were a contributor to that volatility. So we'll be watching and hoping that people aren't going hungry later this year.
Yeah, we certainly hope so. We know that Ukraine is a major exporter to many African countries. These countries rely on Ukraine for wheat and sunflower oil, as you mentioned. So this is an very unfortunate situation. But talking from an investment angle, Invesco offers an agriculture fund. It is DBA, Invesco DB Agriculture Fund, which invests in 10 agricultural commodity futures contracts. Talk to us about this ETF.
Sure. So you're right. DBA holds a diversified basket of agricultural commodity futures. So the major holdings are going to concentrate. The highest weights would be on corn, wheat, soybeans. We're also going to hold substantial weight to sugar, but then we also have allocation to some of the softs. So you're going to own coffee, cocoa, cotton in the smaller weights, and then there's also an allocation to the meats. So you're also going to own a little bit of live cattle, feeder cattle, and lean hogs. So it really is a basket that gives you somewhat broad exposure to the agricultural sector, but what would particularly heavy tilt towards the grains, the major row crops. And I should also mention that as with the energy ETFs, all of our commodity ETFs, including the agriculture ETF DBA, fully optimizes the futures role. Now there are a few. I will just caveat there, truth in advertising. There are a few of the less liquid, I would say, relative, to the major crops. There are a few holdings in there where there isn't enough liquidity in the later dated futures contracts to optimize, and so we would stay in the liquid front month contract. You'll see that in a few of the softs and in the meats, but the larger holdings, we do optimize the futures role.
So now let's talk about metals. And we have seen some insane moves in some of the metals, particularly nickel. There was a day when nickel prices surged more than 70%, and the London Metal Exchange had to suspend trading in nickel because Russia is, again, a major producer of nickel. Other metals, too, there's a lot of supply for these metals, palladium, zinc, aluminium. A lot of supply comes from Russia, so that is why we have seen these metal prices also surging. So talk to us about your outlook for metals and the impact of this crisis on the metals.
Well, I guess to some degree, depending on how you look at it, we're a bit fortunate. We don't own nickel futures currently in any of our commodity-related ETFs. But so we haven't had that to deal with trying to trade that metal while it's not trading to accommodate investor flows. But copper, aluminum, and zinc are metals held in several of our ETFs. And as you mentioned, while nickel's up 60% year to date, aluminum's up 25% year to date, and zinc is up 22% year to date. Copper, interestingly, because Russia isn't as important a player there, up only about 7.8% year to date, which of course looks awfully good, even 8% relative to equities and fixed income this year, but doesn't seem like much when you're looking at some other metals up, 25 to 60%. Even iron ore is up 42% this year. But yes, obviously. Now, what's really interesting, especially when you look at the metals, is that they were on quite a run based on medium and longer term fundamentals before the war in Ukraine ever broke out or began. The war in Ukraine has exacerbated that bull trend. But when you take a step back and you look at the fact that aluminum was becoming very tight, that the supply and demand curves for copper were likely in about 2 years from now to go into significant deficit, and zinc having had performed quite well as well, just based on growth in demand from the renewable and electric vehicle sectors. Decarbonization, the desire or the drive globally to convert the transportation fleet to electric vehicles and to convert power generation from fossil fuels to renewables has set the world up for massive increases in demand for industrial metals. As we try to replace, in 10 or 20 years, infrastructure that was built out over 100 years. And so, we were very bullish from a cyclical standpoint on industrial metals to begin with. And then, of course, the war in Ukraine now has impaired potentially the supply of those metals to some degree, to the extent that Russia is a significant supplier in some of those markets. So it's once again, we had a market that was already getting very tight, didn't really have any room to absorb a supply shock, and then we got a supply shock. So volatility has been very high there, very high. On any given day, I wouldn't want to try to predict whether that metal was going up or down. And on the other hand, I really, our view is that you really, as an investor, that the risk and reward is very appealing in the medium to longer term. There are various research houses that estimate, for example, that we'll need 5 times more copper in 2030 than we consume today. That will be consumed, or some say we'll be consuming 10 times more copper than we consume today. You could say the same for nickel, obviously, as the demand ramps up for lithium-ion batteries and the use there. Aluminum as well, right, as both a conductor of electricity for long-haul power cables, or as a component of electric vehicles and making them lighter and extending the range. Demand is expected to be orders of magnitude higher. Prices could go orders of magnitude higher if we don't get literally trillions of capital investment into the mining sector to produce more of these metals. And right now, it's very difficult to expand a mine or open a new mine because of the increasing burden of environmental regulation and permitting. So one estimate I heard of from an expert about a month ago is that it takes 10 to 15 years to open a new copper mine. Well, if we're going to need to increase copper production by 500% 10 years from now, we have to start that process now. But how do we start that process now if it takes 10 years to permit a new mine? So those are some of the hurdles, right, that are facing the supply side of the industrial metals sector. And, the demand projections are rather eye-popping. And they're fairly grounded in hard numbers around, how much of that metal it'll take to build the number of electric vehicles that the governments want to have built to hit our carbon emission goals 10 years from now. So, we've got a lot of wood to chop, and the likelihood of higher prices, being needed, right, to incentivize the investment required to bring up the supply of those metals, that is very high.
So it looks like that prices of energy metals and agriculture commodities, they all will continue to go up. So instead of betting on a particular group of commodities, like investing in just energy futures ETFs or metals ETFs or agriculture commodity ETFs, most investors prefer to invest in a diversified commodity ETF. And you talked about volatility too. So investing in a diversified commodity ETF that kind of takes care of some volatility at least. And you offer two very popular broad commodity ETFs, PDBC, which is actively managed. And this, I believe, is the largest commodity ETF currently with about 7.9 billion in assets. And you also offer DBC, which is the older ETF. And one of the differences that I noticed between the two is PDBC is actively managed and DBC tracks an index. But there are other differences too between these two ETFs. So tell us about the differences and why you decided to launch PDBC when you already had DBC.
The primary impetus for launching PDBC was to offer a portfolio similar to DBC's, but to get rid of the K1 tax form that goes along with DBC and several of the older generation commodity futures-based ETFs. So PDBC delivers a 1099, a bit simplified, right, tax reporting structure. For some clients, that is highly preferential. I guess the price that investors pay for getting rid of the K1, and this goes for PDBC, it goes for any 1099 producing commodity fund out there, and that is that commodity related profits have to be distributed each year in the form of ordinary income. So for investors, that own commodities in a qualified account, that's not a major burden. But for taxable investors, you do get a different outcome between the K1 and the 1099. The K1, commodity related profits pass through the K1 60% long-term, 40% short-term capital gains treatment. So that can give a very different net of tax outcome to the investor. But it goes along then with taking that K1, typically comes out in late February or early March, and having to process that with your tax return. So those are really the major differences. If you look at the two portfolios and their historical performance, they track very, very closely to each other. So most clients, even though DBC is passive and PDBC is active, the active component in PDBC is fairly confined. And you see that in the relative performance of the two funds. So most clients tend to prefer one or the other simply based on the tax reporting structure that is most appealing to them.
Yeah, most investors would like to avoid K1 form, I understand. So that is one of the reasons probably why PDBC has been so popular with investors. And full disclosure, I own the ETF and the ETF investor portfolio that I manage. So I also wanted to talk with you about investing in commodity equity ETFs. So investors can, either invest in ETFs that invest in stocks, energy stocks, or they can invest in commodity futures ETFs, the ETFs that we discussed today. I was interested in your perspective on the differences, or are there any advantages, disadvantages of investing in futures-based ETFs versus equity ETFs?
So there's a couple different things to consider. One of the things that you alluded to earlier, Nina, around investing in futures-based commodity ETFs is the issue of roll yield. So contango, which was fairly prevalent in the 2011 through 2019 timeframe, at the end of the day, contango creates a drag on portfolio returns by imposing a negative roll yield as you sell the near dated futures contract and roll to the later dated futures contract. We are, however, broadly speaking, in a very backwardated market. So we're no longer in contango on a net basis. PDBC's portfolio, for example, is deeply backwardated. And on any given day, investors over the last few months have been able to buy into a roll yield, 12-month annualized roll yield in those portfolios of somewhere between 13 and 19% a year. Really incredible. Steeper than any of us can ever remember. Any of us that have been in these markets for less than 30 years have never seen a backwardation this steep, but it speaks to, the tightness in those markets. Essentially, the shape of most commodity futures curves are the result of the levels of inventory and storage. So when you're running low on a commodity, tends to push up spot prices and create a steeply backwardated curve, and we're running low on a lot of things. And so that positive roll yield is something that you wouldn't directly experience in an equity-based commodity portfolio. That's something that you get from directly owning the commodity futures. Now, on the when commodity futures were in contango in the prior decade, and you were experiencing negative roll yield, that made owning the equities around a relative basis more appealing, at least with respect to that issue. And so we did see somewhat of an investor preference migrating over to the equities in the last decade, but those incentives have reversed over the last couple of years. And it's not to say that you shouldn't own the equity, but with respect to roll yield now, the direct calculation, puts an advantage towards owning the futures directly. Now, the equities tend to be more volatile than the underlying commodities themselves. It's somewhat of a leveraged exposure to the commodities. And, at the end of the day, it really depends on what the investor is looking for in their portfolio. From a tactical standpoint, if you believe that the commodity is going to go higher, and then you think, well, maybe I should buy the equity instead of the commodity. I should buy the commodity producer, right, or the commodity refiner. The problem there is that you have to be right about the price of the commodity. Then you also have to be right about in your assessment of the valuation for that equity. In other words, what is the future price for that commodity that is already baked into the price of that equity? So equities tend to be very forward-looking, relentlessly discounting future expectations. Whereas commodity prices really are tied to current supply and demand. The commodity prices are the result of supply and demand meeting and that physical commodity market clearing on a daily basis. So spot prices in commodities really are not any measure of what that commodity will be worth a year from now. But the equity price, equity investors may be baking a future expected commodity price into that equity valuation today. So it's harder to be right twice, in my view, than to be right once. And that's the risk you take by buying an equity, is you could be right about the price of the movement in the underlying commodity, and you could still lose money owning the equity because the equity valuation that you bought into may have been assuming an even higher price, right? Future price for that commodity. That is a problem that many of my friends who run asset allocation models have run into over the last few years. And they come to me shaking their heads saying, man, I was right about crude oil, but I didn't make money on my equity allocation because at the end of the day, that crude oil move disappointed the equity investors.
Yeah, thanks for explaining the differences. I think it is very important for investors to actually understand what their ETF holds, and if they're investing in futures-based ETFs, then just to understand whether the futures curve is in contango or backwardation, and what is the impact of that, the shape of the futures curve. Now, switching gears a little bit, I also wanted to talk a little bit about clean energy ETFs. And we had you in the past on the show to discuss those clean energy ETFs, which did so well in 2019 and 2020. Now, last year they underperformed mainly because investors pivoted out of growth stocks into value stocks, and President Biden's very ambitious Build Back Better agenda kind of faltered. But I think this war will have a profound impact on the clean energy markets too. And in fact, it could accelerate the world's transition to clean energy. So that is why we have seen a lot of interest in clean energy ETFs also since the war started. Your ETFs like PPW and TAN have been doing quite well. So I was just interested in your thoughts on the outlook for clean energy stocks and ETFs in light of this war.
Yeah. Wow. It's interesting. I am very bullish on both, traditional commodities and energy commodities as well as the clean energy stocks. My view personally is that, and of course, just Econ 101, generally the higher the cost of crude oil and the fuels created from crude oil, like gasoline and diesel, right? The more incentive the consumer has to switch to an electric vehicle. So these higher, there are a lot of advocates of the energy transition to electric vehicles who quietly are cheering for higher prices for gasoline because they know that will create further incentive to switch to electric vehicles. So to your point, Nina, these high prices for fossil fuels certainly create better economics to accelerate the transition to clean energy and electric vehicles. And of course, you also have, generally speaking, a lot of momentum as far as the social consumer trends are concerned. Consumers, especially in the United States, have become much more interested in electric vehicles over the last 2 years than they were previously, based on survey data that we've seen. You certainly have in the developed world a fairly high degree of consensus amongst politicians and government regulators that they want to push the market in that direction. So there's a lot of tailwinds for the economic and regulatory and political and social tailwinds for the clean energy sector. A lot of reason to be optimistic there. It sold off, I think, in sympathy with both the broader equity market as interest rates were rising earlier this year, as well as I think there was a fair amount of disappointment and knee-jerk selling after President Biden's Build Back Better plan was defeated in Congress. But I think my view personally is that the market overestimated the importance of the passage of that bill as it relates to the fortunes of these companies. The market's been going that way for years, and policy coming out of Washington could has the potential to create a modest headwind or tailwind, but the world's been going in that direction. And any particular piece of legislation in the U.S., I don't think over the medium to longer term is really the critical factor. And so, I think dips are buying opportunities if you have a medium to longer term view with respect to clean energy stocks. So PBW, as you mentioned, PBD being the global version of that, and TAN, of course, being the ETF focused solely on the solar value chain.
Excellent stuff. And I agree with you that we will continue to see this transition to clean energy. It will accelerate in the coming months, coming years. So it makes sense for investors to look at the buying opportunities when these stocks have sold off. And that's all we have time for today. Jason, thanks so much for joining us.
Absolutely. A pleasure, Nina. Thank you.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe to our show so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.